Welcome back to Accounting 102. In this video, we're going to cover Chapter 11, Standard Cost and Balanced Scorecard. Learning objectives for this chapter to describe standard cost, determine the direct materials variances, determine direct labor and total manufacturing variances, prepare variance reports, and the balanced scorecards. Standard costs. Very common in business and represent predetermined unit costs which companies use as a measure of performance. It's very, very popular in every manufacturing facility I've worked in, use standard costs of some sort. So here's some advantages. They facilitate management planning, promote greater economy by making employees more cost conscious, useful in setting selling prices, contribute to management control by providing basis for evaluation of cost control, useful in highlighting variances in management by exception, and simplifying costing of inventories and reduce clerical costs. So what are some differences between standards and budgets? Both are predetermined costs, and we've seen how we can develop budgets in the last couple chapters. Both contribute to management planning and control. But there is a difference. A standard is a unit amount, so it's a cost per unit of activity or unit of finished good, and a budget is a total amount. So you're looking at the total together, and a lot of times budgets use standards to be created. To set very good standards, it requires input from all persons who have responsibility for costs and quantities. So it should be similar to effective budgeting when it's participative and everybody is involved in budgeting. You can use that same data or a lot of the same data, but the same concepts as well to set standard costs. Standard costs need to be current at all times. So in my experience, most companies set a standard for the year and then they keep that for the year. Unless something significant happens, which leads to the next point where standards should change whenever managers determine that existing standard is not good measure of performance. So maybe just some of my industries or whatever, but we've set a standard for the year. A lot of times we have annual purchasing agreements with suppliers, so our costs are known for the year. Maybe only freight is going to vary, or if we have special orders, which usually isn't big enough to change the standards. So we set the standards once a year. We roll our standards at the beginning of the year, and then we just operate on variances off of those standards. Now, if something were to happen significantly, like tariffs come in, that may be a reason to reset the standard so you can include those higher costs. Companies set standards at one of two levels, ideal standards or normal standards. Ideal standards represent the optimum levels of performance under perfect operating conditions, which is rarely ever met. This is looking at, we're going to run the factory X number of hours a week. We can produce, each machine can produce so many goods or pieces per hour. Setup time is known and consistent, and there's no breakage in the equipment. So that's the ideal standards. It's optimal. Normal standards are really how you're going to run the business. Efficient levels of performance, attainable under expected operating conditions. So you know your workforce, you know how they're going to operate. You kind of look at history of how many parts per hour or parts per shift can be made. So it's more realistic. Shouldn't be too low that it's easy to obtain, so it should be rigorous but also obtainable. So if historically you're running at 80% efficiency on a particular machine, you might set the standard at 85 to give you some challenge and try to improve your performance. But it wouldn't make sense to set it at 95 just because that's the way the manufacturer says it should be able to run. You'll never meet that, and then the standards would be useless, and people wouldn't bother trying to improve because there's no way they're going to meet the standard. So that's kind of what we're talking about with the difference between ideal standards and normal standards. Again, most companies are using normal standards, which brings us to the review question. Most companies use standards that set them at optimum, ideal level, normal level, or practical level. The answer is normal level. So what's the normal operating? Again, you want to challenge the operations team to get better. So it may not be, it may be a little bit harder than, or more efficient, more parts per shift or hour, however you're measuring it, than what they've run in the past, but definitely not the ideal level. Oops, wrong way. Direct material standard, price standard is the cost per finished unit of direct materials that should be incurred. Okay, so we're going to look at what's our purchase price, net of any discounts we're going to get, the freight that we're going to have to pay, any receiving and handling costs can get included into that. And this is in a per pound of material. So it's standard direct materials price per pound, $3. So then we'd have to look at how much direct material should be used per unit of finished good. So we have required materials, 3.5 pounds, allowance for waste, 0.4 pounds, allowance for spoilage, 0.1 pounds. So we come up with 4 pounds of material to make one finished unit of finished goods. Okay, so that's our normal operating and what our standards are going to be based on. So yeah, we do allow for some waste, we do allow for some spoilage, because we know we're not going to use every pound or ounce of direct materials that we receive in. There's going to be some waste and some spoilage. Now, you don't want to overinflate that because it'd be too easy for operations to meet it, but you want it to be realistic and kind of acknowledge that, if I bring in 7 pounds of material, I'm not going to get 2 unit of finished goods out of it, because there is going to be some waste and some spoilage. It's just normal process of processing that material. So now if we get the standard direct materials standard direct materials cost per unit, again, we're talking about finished goods unit. We just take the standard direct materials price. In this case, we have $1 per pound. The amount of materials we're going to use, in this case, 4 pounds per gallon. Gallon is our ending unit of measure. So 3 pounds, $3 per pound times 4 pounds, we get $12 per gallon. Our standard would be set at $12 per gallon, the gallon being our finished goods unit. Another review question. The direct materials price standard should include an amount for all of the following except receiving cost, storing cost, handling cost, normal spoilage costs. So which one of these should not be included in the direct materials price? The answer is normal spoilage costs. Okay. If you remember back a few slides, we had the cost of the material, the freight, and then the handling and receiving, or receiving and storing. I forget what it was referenced, but those first 3 costs are normal costs. It was the usage, the amount of material we used per each finished good, where we brought in the idea of the spoilage into that. So we'll put the weight of that spoilage, and then that'll get multiplied by the cost. Direct labor price standard is the rate per hour that should be incurred for direct labor. Okay, we've seen this before, but we've kind of just had a number out there of hourly rate, that type of thing. We'll also include cost of taxes and benefits. Okay, so COLA, cost of living adjustment, 25 cents, payroll taxes that the company is paying, not the payroll taxes that the employee pays, but the employer's part of that. And then fringe benefits, things for like healthcare. You might have vacation pay included in there, that type of thing. So you're going to load it up, and we get a standard direct labor rate per hour. I've seen it referred to as fully loaded or fully burdened labor rate, which is different from our just hourly wage rate that we pay our employees. It's including all the taxes and benefits as well. The direct labor quantity standard is the time that management determines should be required to make 1 unit of product. So we have production time, so it takes an hour and a half of production time, but we have to give our employees breaks, rest periods. They have to have time for setup and cleanup. Setup, could be changing over the machine to a new product, or as pieces wear out in a normal process, you need to add a different tool into the machine, that type of thing. So you have to acknowledge that time is actually there, and the employees are on site, so they're getting paid. So you add some time also into the cost or the time of it takes to produce the unit, and can capture some of that cost as well. So in this example, even though it takes 1.5 hours of actual production time to produce 1 unit, we're going to set the standard at 2 hours to take in some of that other time. The standard direct labor cost per unit, similar to what we did for direct materials, we're going to multiply the rate per hour times the number of hours to produce a finished good. We came up with $15 per hour with all the taxes and benefits included, 2 hours with our setup and downtime and cleanup and rest periods. So $15 times 2 hours, $30 of labor cost per gallon. Again, that's our finished goods measure, a gallon of product. Manufacturing overhead. For manufacturing overhead, companies use a standard predetermined overhead rate in setting the standard. And this is pretty much like we've seen before with overhead. The overhead rate is determined by dividing budgeted overhead cost by an expected standard activity index, such as direct labor hours or standard machine hours. So not really different than what we've seen before. We're just now calling it a standard instead of a predetermined rate, but it's really the same thing. So Zonic uses standard labor hours as the activity index, expects to produce 13,200 gallons during the year at normal capacity, takes 2 direct labor hours for each gallon. So we take our budgeted overhead costs, and we're going to divide it by our standard direct labor hours. So 13,200 gallons, $2 each is going to be 26,400 labor hours. So we divide the cost by the hours, and we get a rate per hour. So in this case, our overhead is $5 per hour. So that'd be $5 for each finished good again, which is the gallon, it's $5 per hour. Then we know that it takes 2 hours of direct labor. So $5 times 2 hours, $10 is the rate per direct labor hour to get a finished good. So if we look at it all together, the standard cost per unit is the sum of the standard cost of direct materials, direct labor, and manufacturing overhead. So direct materials was 4 pounds at $3 a pound, so $12 per gallon. Direct labor, 2 hours, $15 per hour, so $30 per gallon. And manufacturing overhead, it's based on direct labor hours, so again, 2 hours there, $5 per hour gives us $10. So for 1 gallon of our tonic that we're making, it costs us $52 per each of those gallons. Now we'll go through another example. So Write-It incorporated accumulated the following standard cost data concerning product CTY31. Direct materials per unit takes up 1.5 pounds of direct materials at $4 per pound. Direct labor per unit, a quarter of an hour at $13 per hour. And manufacturing overhead, it's a rate of $15.60 per direct labor hour. We need to compute the standard cost of 1 unit of product CTY31. So we're going to take all of these quantities, pounds for direct materials, hours for direct labor, hours for manufacturing overhead, times their respective rates. And then that'll give us a cost per unit of finished product. So here's how you do that. Direct materials, 1.5 pounds times $4 is $6. Direct labor, a quarter of an hour at $13 per hour, $3.25. And manufacturing overhead, again, a quarter of an hour because it's based on direct labor. $15.60 is the overhead rate. So it's $3.90 per unit. Total of $13.15 per unit. Now we'll look at direct materials variances. We've set our standards. We're going to use our standards and to help build budgets or forecasts, and then we're going to look at our variances. So variances are the difference between total actual cost and total standard cost. We've looked at variances a little bit when we looked at budgets, whether we use the static budget or a flexible budget. We looked at it at a line item. Now we can look at it at a unit level of our standard cost. So if our actual costs are less than our standards, we have a favorable variance. If our actual costs are higher than our standards, greater than our standards, we have an unfavorable variance. So we must be analyzed to determine the underlying factors to try and understand that. And then we can break the standard down to analyze to determine the cost components that comprise the variance, and we're really going to look at quantity and price are the two big things that we'll look at. So a review question, a variance is favorable if actual costs are less than budgeted cost, less than standard cost, greater than budgeted cost, greater than standard cost. If a standard variance is favorable, it's less than our standard cost. So let's look at how we compute the total variance. So Zonic Tonic, in the month of June, we produced 1,000 gallons. Zonic incurred the cost to the right. So we had direct materials, direct labor, variable overhead, fixed overhead, totaled $55,000 of actual cost. The total standard cost of Zonic Tonic is $52,000. So it was that $52 per gallon that we looked at before, times the quantity that we produced, 1,000 gallons. So we had $52,000. Our actual cost for 55, so we had a variance of $3,000, unfavorable variance, because our actual costs were higher than our standard cost. Now that $52 we looked at was total cost. It had direct materials, direct labor, and overhead. So the variances of each of those added together is going to equal our total variance. And if we look at this graphic, we get our total materials or labor variance at the top. This is the difference between our actual cost, our actual quantity at our actual price, and our standard cost, our standard quantity at standard price. We can break that down between a price variance and a quantity variance. So the price variance will take actual quantity at actual price, compare that to actual quantity at standard price, and that'll give us our price difference. And then if we take our actual quantity at standard price and compare that to our standard quantity at standard price, we get our quantity variance. Okay, so in each of these, we're keeping one thing constant. So in the price variance, we keep the quantity constant at the actual quantity, change the price, see what that variance is. To get the quantity variance, we keep the standard price the same, and we apply the actual quantity and the standard quantity. And then that difference in quantity is going to give us our quantity variance. So let's look how that works. So in completing the order for 1,000 gallons of Zonic Tonic, Zonic used 4,200 pounds of direct materials. These were purchased at a cost of $3.10 per unit. Standard price is $3. So our actual quantity at actual price is going to give us 4,200 units, so 4,200 pounds in this case, at $3.10. So our actual quantity and our actual price, $13,020. Our standard quantity at our standard price is 4,000 pounds. Remember, it's 4 pounds per unit. We had 1,000 units, so 4,000 pounds times $3, our standard price, $12,000. We had an unfavorable total materials variance of $1,020. Now we can break that down into price and quantity. So if we look at materials price variance, looking at the price, we're going to compute that by taking our actual quantity at actual price. So our 4,200 pounds at $3.10, the $13,020. But instead of taking standard quantity at standard price, we're going to take our actual quantity at standard price. So 4,200 units, or pounds in this case, times $3 gives us 12,600. Okay, so we have the same quantity on both sides. We just are changing the price. One is our standard of $3, one is our actual of $3.10. So we get a materials price variance of $420 unfavorable. Then we can look at our quantity variance, and that is taking our actual quantity at standard price minus our standard quantity at standard price. That gives us our materials quantity variance. So actual quantities was 4,200 pounds. We use our standard price of $3, so we get 12,600. And we get our standard quantity of 4,000 pounds at $3 of our standard price. It's $12,000. We get $600 unfavorable materials quantity variance. So then if we add our materials price variance, $420 unfavorable from the previous slide, our materials quantity variance from this slide of $600 unfavorable, we add those together, we get total materials variance of $1,020 unfavorable, which is what we saw a couple slides ago when we just calculated the total variance. So we took that 1,020 and broke it into its pieces, to say which was driving it, the quantity or the price. In this case, they both were unfavorable. And if we go back to our graphic, we can plug in the numbers there. You can see it all together. The total at the top is the actual quantity at actual price compared to the standard quantity at standard price, the $1,020 unfavorable, and we can break it into a price and quantity variance. So what causes some of these variances? So materials price, it could be the availability of quantity and cash discounts, the quality of the materials requested, the delivery method used. So all of those could be things that could change the price. So if you, for example, buy material from multiple suppliers and you set your standard assuming you're going to buy from supplier A, you end up buying more from supplier B that's at a different price, you're going to have a price difference. Okay. Same thing if you were going to assume you're going to be buying from a certain location and factored in the freight from that location. You actually had to buy it from a different location with higher freight costs. You're going to have a price variance. So to the extent that these factors are considered in setting the price standard, the purchasing department is responsible for any variances. So if the purchasing department comes up and says, here's where we're going to purchase from and what the costs are, then anything that's different than that is going to be their responsibility. Materials quantity variance. If the variance is due to inexperienced workers, faulty machinery, carelessness, the production department is responsible for any variances. So the purchasing really is the price. The production department is more of the quantity because they're the ones taking the raw materials and turning it into a finished goods. So let's try this again. Standard cost of Wonder Walkers includes 2 units of direct materials at $8 per unit. During July, the company buys 22,000 units of direct materials at $7.50 and uses those materials to produce 10,000 Wonder Walkers. Compute the total price and quantity variances for materials. So first, let's look at what our standard quantity would be. 2 units of direct materials are needed to produce 1 unit. We produced 10,000 units. We should have used 20,000 units of direct materials. And then if we substitute the amounts in the equations, the variances are total material variance. We take our actual quantity, 22,000 units, times our actual price, $7.50 per unit, minus our standard quantity times standard price, so 20,000 units at $8. We see that we're $5,000 unfavorable for total materials variance. Now, if we look just at the price to figure out the price variance, we're going to take the actual units times the actual price compared to actual units at standard price. So 22,000 times 750 and 22,000 times 8. When we do that, we find that our materials price variance is $11,000 favorable. Okay, so we bought it cheaper than our standard, 750 versus 8. So from a price perspective, we were favorable, 11,000. Okay. If we're 5,000 unfavorable, we know already that it's going to be $16,000 unfavorable for the quantity because it's just substituting the equations. The price variance plus the quantity variance is going to equal the total. If we know two of those, we can figure out the other one. But let's look at how we actually would calculate that independently. So the quantity variance is going to take our actual quantity at standard cost, our standard quantity at standard cost. Any difference will be our quantity difference. So we're keeping the cost the same at our standard cost and just looking at changes in quantities. So that gives us our $16,000 unfavorable. So we were favorable in price. We had a better job of procuring our direct materials, but we used more to make our 10,000 walkers than we should have based on our standard. So we were unfavorable in materials quantity, and that was more unfavorable than our price was favorable, so we were total variance unfavorable. Now we're going to determine the direct labor and total manufacturing overhead variances. The process for determining direct labor variances is the same for determining the direct materials variances. So we're going to get a total labor variance. It's the difference between amount actually paid, actual hours times actual rate, versus the amount that should have been paid, our standard hours at our standard rate. Okay, just like we did for materials, and then we're going to be able to break that into quantity and price as well. So in completing the Zonic order, Zonic incurred 2,100 direct labor hours at an average hourly rate of $14.80. Standard hours allowed for the units produced were 2,000 hours, 1,000 gallons, 2 hours per labor for each gallon. The standard labor rate was $15 per hour. So our total labor variance is as we see below. Actual hours times actual rate, 2,100 actual hours at $14.80 per hour, $31,080. We're going to subtract our standard hours times standard rate, 2,000 hours at $15 per hour, $30,000. We see that we're $1,080 unfavorable. So our total labor variance is unfavorable. Just like we did with materials, we can break that into price and quantity. So we're going to analyze the total variance to determine the amount attributable to price or cost in quantity or use. Labor price variance is similar to what we did for materials. We're going to use actual hours times actual rate minus our actual hours times our standard rate. So we're keeping the hours the same and just changing the rates. So in this case, 2,100 hours at $14.80, actual and actual, $31,080. Our standard rate at those actual hours would have given us 31,500. So again, that 2,100 actual hours times our $15 standard rate. So we see that we're $420 favorable from a labor price perspective. So our labor price variance is $420 favorable. Then if we look at the labor quantity, we take actual hours at standard rate minus our standard hours at standard rate. So 2,100 actual hours times $15 standard rate is 31,500. Compare that to our standard hours of 2,000 at our standard rate of $15 of 30,000. We see that we're 1,500 unfavorable. And then again, the direct labor variance that we calculated earlier is 1,080 unfavorable. So it's 1,500 unfavorable for quantity and $420 favorable for price. That gives us our $1,080 total labor variance unfavorable. And here it is, kind of the same graphic that we looked at when we looked at the materials. We can do the same for labor. So our total at the top, broken in between price and quantity. So what causes the variances? A labor price variance. So the price side of it usually results from two factors. Paying workers different wages than expected. Okay, so if it's favorable, you could have had some new hires that came in at a lower rate than you expected. If it's higher, it could be overtime that you're paying, something like that. And then a misallocation of workers. So again, it's you typically don't pay every worker the same. So if you thought certain workers were going to work in certain departments, and then they actually work, they're in different, a different department, you're going to get some variances because of that. So that's the misallocation of workers. So when workers are not unionized, a manager who authorized a wage increase is responsible for higher wages. Okay, so union companies, they have set scales, so you kind of are a little bit more locked in. Non-union, the manager has discretion usually for what they pay their workers, so they'll be held responsible for wage increases. And then the production department is generally responsible for labor price variances resulting from misallocation of workforce, so putting people in different jobs, that type of thing. So we can't really tell from our price variance what that was. We'd have to investigate a little bit further to kind of dig into what the underlying factor of that, but we know, we can look at the price versus quantity difference to know where we should focus most of our energy in taking it down to the next level. The quantity variance relates to the efficiency of workers. So, if we say it's going to take 2 hours to produce a finished goods, and it actually takes them 2.25 hours, the workers weren't as efficient. So typically, that's the production department that takes on that reason for why they're inefficient. So maybe they have hired some new people that aren't fully engaged. Maybe they have the wrong people again in the jobs, and it's causing some inefficiency. But it's the production department that would take that on. Now we'll look at manufacturing overhead variances. Total overhead variance is the difference between actual overhead costs and overhead costs applied based on standard hours allowed for the amount of goods produced. Computation of actual overhead is comprised of a variable and fixed component. So here we see our variable overhead and our fixed overhead, total of 10,900. The predetermined overhead rate for Zonic Tonic is $5 per direct labor hour. So if we take our actual overhead, the 10,900, times or minus our overhead applied, which was $10,000 in this case, $5 per hour, 2,000 hours to produce 1,000 units. We see that we spent more overhead than was applied, so our overhead variance is unfavorable. We also say that that is a unapplied or underapplied overhead of 900. So the standard hours allowed are hours that should have been worked for units produced. So again, we're not taking in actual hours, we're just taking the actual overhead, and then the overhead applied is our hours times the rate. Overhead controllable and volume variances. Overhead variance is generally analyzed through a price variance and a quantity variance. The overhead controllable variance, the price variance, shows whether overhead costs are effectively controlled. And the volume variance or the quantity variance relates to whether fixed costs were under or over applied during the year. Some causes: over or underspending on overhead items such as indirect labor, electricity, etc. Poor maintenance on machines. Flow of materials through production is impeded because of lack of skilled labor to perform necessary production tasks due to lack of planning, lack of sales orders. So those are all could be causes of having overhead variances. So we'll look at labor and manufacturing overhead variances. Standard cost of product YY includes 3 hours of direct labor at $12 per hour. Predetermined overhead rate is $20 per direct labor hour. During July, the company incurred 3,500 hours of direct labor at an average rate of $12.40 per hour and $71,300 of manufacturing overhead cost. It produced 1,200 units. So we're going to compute the total price and quantity variances for labor and then compute the total overhead variance. So the total variance for labor, we're going to take actual hours times actual rate, compare that to our standard hours at standard rate. So our actual direct labor hours were 3,500. Average direct labor rate was $12.40, so $43,400 actual. Our standard, we produce 1,200 units. There's 3 direct labor hours per unit, so we should have used 3,600 direct labor hours. At our standard rate of $12 per hour, we should have incurred $43,200 of labor. That's our standard. Our actual was $200 more than our standard, so we had an unfavorable total labor variance of $200. So now can we break that into price? Remember, in price, we're going to take actual hours at actual rate compared to actual hours at standard rate. So when we do that, we get our 43,400 for actual with actual rate. Use those same hours, 3,500 times our standard rate of 12, $42,000. So our labor price variance is unfavorable, 1,400. So we paid 40 cents per hour more than our standard rate at our 3,500 hours. That's how we get our $1,400 unfavorable variance. Now if we look at quantity, we're going to take our standard rate, or $12 per hour, at our actual hours and at our standard hours, and then compare that. So our actual direct labor hours at our standard labor hours per unit of $12, we get $42,000. Again, our units produced were 1,200 at 3 direct labor hours per unit, 3,600 direct labor hours times $12. So our standard hours at our standard rate, $43,200. Our standard is higher than our actual, so we say we have a favorable variance of 1,200. Okay, it took us 100 hours less time to complete those 1,200 units than what we had set in our standard. Now the total overhead, we're going to take our look at our total manufacturing costs, 71,300, and then compare that to our standard overhead or overhead applied. So we take our units produced again, 1,200, standard direct labor hours per unit of 3, so 3,600 direct labor hours, times our predetermined overhead rate, our standard overhead rate of $20 per hour. So we applied $72,000 of overhead, which was more than our actual. So we have a favorable overhead variance of $700. Now we'll look at our variance reports and balance scorecards. So variances should be reported to appropriate levels of management. The form, content, and frequency of variance reports vary and facilitate principle of management by exception. Management normally looks for significant variances. So similar to what we looked at last chapter when we talked about responsibility reporting and looking at the budget versus actuals in total, we do the same thing for labor, materials, and overhead variances. So the materials price variance report for Zonic Inc. with materials for Zonic Tonic order listed first. So that X100 material, 4,200 pounds, actual price, standard price, price variance, $420 unfavorable. That's what we had calculated before. And we put an explanation there that it was a rush order. We have two other products. We've got their quantities purchased, and see the quantity purchased is in different units of measure. So you just need to be aware of that, you can't look at these prices for different rows because they have different units of measures, but that's appropriate to use. Favorable for the X42 because we had a quantity discount. Our A85 was unfavorable. We paid more than our standard, and it says our regular supplier was on strike, so we had to buy from a different supplier. Now, if we look at our income statement presentation of variances, with a standard cost accounting system, cost of goods sold is stated at standard cost, and the variances are disclosed separately. So our cost of goods sold on the income statement will be at standard. Then our unfavorable variances will be added to that. So it's an increase in cost of goods sold, which decreases our net income. If we had favorable variances, it actually decreases our cost of goods sold, which will increase our net income. So here's what it would look like. This illustration is based on production and sale of 1,000 units of Zonic Tonic at $70 per unit. So that's where we get our sales revenue. Since we had 1,000 units, our standard cost was $52 per unit. So we had $52,000 of cost of goods sold. And we have our gross profit at standard. We then take all of our variances. We had materials price, materials quantity, labor price, labor quantity, and overhead. And if we sum those up, we get a total unfavorable variance of $3,000. So just be careful as you're adding these up. We have 4 that are unfavorable and 1 that's favorable. So you have to make sure you add and subtract correctly to get the correct total variance if it's favorable or unfavorable. So our $18,000 gross profit at standard, but we had 3,000 unfavorable variances. So our gross profit actual was $15,000. Then we take our selling and administrative expenses and get our net income. So a review question on variance reports: which of the following is incorrect about variance reports? So 3 of these are correct, 1 is incorrect. And the incorrect answer is that they should only be sent to the top level of management. Should go to the appropriate level, and the appropriate level being who would be responsible for the variances, and then the different levels above that as well. Now finally, we'll talk about balanced scorecard. This incorporates financial and non-financial measures in an integrated system that links performance measurement and a company's strategic goals. It evaluates company's performance from a series of perspectives. 4 most commonly employed perspectives are financial, customer, internal process, and learning and growth. So those are the perspectives. The non-financial measures used in various industries. So in the auto industry, you could have capacity utilization of factories, impact of strikes, average age of assets, brand loyalty, computer systems, market profile of customer end products, number of new products, employee stock ownership percentages. So you can see different industries are going to have different non-financial measures. And if we look at objectives within the four perspectives, so for financial, we could have return on assets, net income, credit rating, share price, profit per employee. For customers, we're going to look at percentage of customers who would recommend the product, customer retention, response time per customer request, brand recognition, customer service expense per customer. Internal process, we'll look at percentage of defect-free products, stockouts, labor utilization rates, waste reduction, planning accuracy. We would also look at on-time delivery or on-time in full. So how many orders were delivered on time and the full order, so we didn't short the customer. So that's another one that could be useful. Learning and growth, percentage of employees leaving in less than 1 year, number of cross-trained employees, ethics violations, training hours, reportable accidents, all things that are looking at your employees and are you retaining them? Are they working safely, getting trained so they can learn and grow? Review question for the balanced scorecard. Which of the following would not be an objective used in the customer perspective of the balanced scorecard approach? Okay. In the customer perspective, you would not use earnings per share. That's a financial measure, would be in the financial perspective. It's a good objective, especially for public companies, something that would be there, but it would not be in the customer perspective. Summary of balanced scorecard. So it employs both financial and non-financial measures, creates linkages so high-level corporate goals can be communicated to the shop floor, provides measurable objectives for non-financial measures, integrates companies' goals into a single performance measurement system so that an inappropriate amount of weight will not be placed on any single goal. So let's do another problem for reporting variances. Polar Vortex Corporation experienced the following variances. Materials price, $250 favorable. Materials quantity, $1,100 favorable. Labor price, $700 unfavorable. Labor quantity, $300 favorable. Overhead, $800 favorable. Sales revenue was $102,700 and cost of goods sold at standard was $61,900. Determine the actual gross profit. So what we'll do is produce an income statement. We'll start with our sales and our cost at standard. That'll give us our standard gross profit. Then we will add our favorable variances, subtract our unfavorable variances to that gross profit to get our gross profit actual. And this is what it looks like. So the sales revenue minus the standard cost of goods sold gives a standard gross profit of $40,800. We had a net variance of $1,750 favorable. So that increases our profit. So our gross profit increases to $42,550. That's it for chapter 11. As always, reach out if you have any questions. Thank you.